Hello, everyone. Thank you for joining this breakout session focused on the Municipal Pension Plan 2024 Actuarial Evaluation. My name is Glenn Brown, and I'm the chair of the Valuation Committee. With me today is Catherine Robinson, the Municipal Pension Plan Actuary. So today's session, we'll provide insights and context around this year's actuarial evaluation. We'll discuss key findings and, most importantly, address some of your questions. We are recording this session today because the live event originally scheduled for October 16th was canceled due to the ongoing labor dispute with BCGEU. When you and other members and employers registered for the planned live event, we asked for questions to be pre-submitted. We received plenty of questions at this time, and we used them to inform today's presentation, and we will directly address the top questions received. But before we get started, Catherine, I'm curious about your favorite hike or trail.
Oh, well, thanks for having me, Glenn. I'm absolutely delighted to be here today. Now, Glenn, I'm a city girl at heart, I have to tell you. And I feel very blessed to actually live in downtown Vancouver. And one of my favorite things to do is actually to get out and walk on the seawall in downtown Vancouver, which I classify as an urban hike. And I feel really privileged that I'm able to do that almost on a daily basis.
Fantastic. No, that sounds great. So now we will share some more information on the valuation. The board has a valuation committee that oversees the work of the valuation. And while we do evaluation every 3 years, the committee meets several times each year to ensure that the work moves forward. One of the responsibilities of the committee is to review and monitor the plan's funding policy, which is an ongoing project. Another responsibility is to advise the board on how to maintain the sustainability of the inflation adjustment account, which funds the cost of living adjustments, also known as COLAs. Of course, we are busiest in the time around the valuation. We'll run this session as sort of a Q&A with our expert, Catherine. And as I noted before, we will also answer some previously submitted questions from our members. Catherine, before we dive into the MPP valuation results, can you tell us in plain terms what an actuary does?
Certainly, Glenn. So we're going to focus on the work that actuaries do relating to pension plans such as the MPP. And you can actually think of actuaries like financial architects, if you want. So we use things like mathematics and statistics and financial theory to assess risk and to ensure that a pension plan has strong foundations that will last for generations to come. We do things like develop assumptions about future events which will impact pension plan members. So these include things like future investment returns and how long members are likely to live in the future. We also provide reports on the financial status of a pension plan, and we calculate how much money is needed to be put into the pension fund each year to make sure that there is enough to pay pensions. And that is to pay pensions not only for current retirees, but also for future retirees too. This allows the pension plan to continue to pay the promised benefits to all of its members.
Great, thanks for that, Catherine. Let's take a look at valuations and their purpose. So what does a valuation tell us? And specifically, what does MPP's valuation tell us?
So valuations you can really think of as a financial check on the health of a pension plan. We look at member data for every single member that's entitled to a benefit, be that a pension payment today or a future entitlement. We rest assured all data is anonymized and it is securely stored. We project the benefits that are expected to be paid in the future. We're considering variables such as how long members are going to live, future expected investment returns, future salary increases, and things like when active members are expected to retire and commence receiving their pension from the plan. We sum all of these projections together across all of the members, and that provides us with an estimate of what we call the plan's liabilities. So that's an estimate of how much money the plan needs today to meet its obligations to pay members. We then compare that liability to the assets in the plan. And from this valuation, we can say that there is enough money in the fund to pay the pension of every single member for their lifetime.
Great. Let's move on to the next question. So the board has set its funding criteria to achieve the following: benefit security, stability of contribution rates, and fair allocation of costs over time. Is this a reasonable set of criteria? And is there anything you'd like to say about these priorities?
Certainly. So firstly, I'd say that these are common criteria for Canadian pension plans. But more importantly, they are reasonable and appropriate for the MPP. So the first one you mentioned was benefit security. Benefit security is really the bedrock of a successful pension plan. It's about honouring commitments. It's about providing financial stability for retirees and future retirees. And it's for ensuring a secure future for generations to come. Benefit security talks to the ability of the plan to pay the pensions earned by all plan members. This is a crucial element of a pension plan being sustainable over the long term. As we just discussed, the latest valuation shows that there is enough money in the fund at this time to meet the expected pension payments for all members. In fact, the valuation showed that the plan is 102.8% funded. So that actually means there's a small surplus over and above what is expected to be needed. The second funding criteria you mentioned, Glenn, is contribution stability. And this is incredibly important for a pension plan's health and long-term sustainability. Contribution stability refers to the consistency and predictability of the contributions made to a pension plan by both members and employers. It's not necessarily about having the lowest contribution rates, but rather it's about avoiding large and sudden swings in those rates. We're pleased to report as well that the latest valuation shows that contributions can remain at their current level. And then the final funding criteria that the board has set that you mentioned, Glenn, was the fair allocation of costs over time. This is about ensuring that the costs of benefits are shared equitably between current and future generations of plan members and employers. It means that the cost of benefits earned today shouldn't disproportionately fall on those who will be responsible for funding the plan in the future. So it's really about spreading the financial requirements over the period that benefits are earned and enjoyed. Now, there are a number of things that we can do to help achieve these funding criteria, and one of which is carrying out the actuarial valuation that we're discussing today. The valuation in itself is a very valuable tool to provide that financial check against the funding criteria and allow us to correct course as needed. And in addition to that, the board also has a funding policy which guides their decision-making following each valuation.
Great. All right, let's move on to the next question. So when we talk about evaluation, we really do two valuations. One is for the basic fund that pays pensions, and one is for the inflation adjustment account, which pays COLAs. We know members are keenly interested in the inflation adjustment account, in the inflation adjustment results. Can you tell us how that valuation differs from the pension fund valuation and what the results mean?
Yep, of course. So yes, as you know, Glenn, we conduct two main valuations. The first is for the basic fund that pays pensions, and that's the valuation we've been concentrating our comments on so far. The primary purpose of this valuation is to determine the contribution requirements. And as I noted earlier, the latest valuation shows that contributions can remain at their current level. I would like to point out, though, that outcome was in part possible due to the rate stabilisation account that the board established in 2016. So this account was established for the purpose of stabilising contribution rates. This is one of the key funding criteria that the board has set that we just discussed. So a small transfer was actually made from the rate stabilization account to enable contribution rates to remain unchanged as a result of this valuation. It's actually the first time that we've drawn down from the rate stabilization account since it was established, but rest assured the account retains a healthy balance for the stabilization of contribution rates in the future. So let's now turn our attention to the second of the main valuations that we conduct, which is a valuation that allows for the inflation adjustment account. So the primary purpose of this valuation is to determine the cost of living adjustments, or COLA, that can be provided for the next 3 years up until the next valuation. For this indexing valuation, the two main funding criteria we focus on are the stability of COLAs from year to year and on intergenerational equity. Now, when we talk about intergenerational equity in this context, what we mean is that each generation of members and their employers should receive a fair benefit relative to the contributions that they've paid into the plan. So we're focusing not only on today's generation in receipt of the pension, but also on future generations of plan members who've earned a pension benefit but have not yet started to collect that pension. The results of this second indexing valuation show that if COLA was to be paid in full for the next 3 years, then there's actually a risk that future COLA payments may need to be cut back disproportionately to future generations. So to balance long-term sustainability and fairness across generations, we've recommended to the board that they apply a COLA cap for the next 3 years. It's important to note that the board's funding policy does address the considerations for a COLA cap, and the board have followed this policy. So what that means is starting January 1st, 2026, COLAs will be paid at CPI or at the rate of 2.1% if less. This will be reassessed at the next valuation in 3 years' time.
Great, thanks for that answer, Catherine. Next question. So one of the most common questions we receive related to valuation is this: what does the funding level mean?
Okay, let's address that one. So the funding level is really a measure of the pension plan's financial health at a point in time. It looks at whether the plan has enough assets to cover its future liabilities, the future liabilities being the pension benefits that have been earned. So we calculate the liabilities, as we mentioned earlier, by projecting the benefits that are expected to be paid in the future. And that's to each and every member with an entitlement under the plan. We're considering variables such as future investment returns, future salary increases, and how long we expect members to live. The funded ratio is then expressed as a percentage of the plan's assets to the liabilities. If we have a ratio or a percentage of 100% or above, then that means at the time of the calculation, the plan has enough assets to meet its obligations. So this most recent valuation showed that the plan is 102.8% funded, so it's actually a small surplus over and above what is expected to be.
All right, another set of questions is about the uncertainty in the markets in the world right now. How does that affect the valuation of the plan's fund?
There's certainly a lot of uncertainty at present, so it's no surprise that plan members and employers may be concerned. Pension plans are designed to provide retirement income for many decades. Their primary goal is to ensure that they can meet those obligations 30, 50, even 70 plus years into the future. So this requires a long-term focus, and the valuation does focus on the long term. Now, we can expect short-term volatility from time to time, and pension plans can't eliminate short-term volatility entirely. So the key is to understand and manage the level of volatility that the plan can tolerate. The board has a number of policies and techniques in place to best manage the short-term volatility, and that includes regular monitoring between valuations. And one of the key tools in place is the regular evaluation, or the financial health check, which we've just conducted. And this also helps the board maintain that long-term perspective.
All right. Catherine, can you share some of the trends you are seeing that affect pension plans?
Certainly. So we touched a little on market uncertainty in the previous question. The trend that we focus on in that regard, as we mentioned, is long-term trends for future investment returns. We've obviously seen geopolitical and inflationary pressures that have caused short-term fluctuations in the recent past. But the impact of those actual historic events in the last 3 years has been recognized in the most recent valuation. So hence our focus continues to be on the future long-term trends. We also keep a close eye on how long members are living. Populations around the world are living longer than they have in the past. And pension plan members tend on average to live longer than the general population as well. So this means that most pension plans need to fund benefits for a longer period in the future than they have in the past, and that increases the liabilities. Now, to recognize this, we actually strengthened the assumption we use for life expectancy for this most recent valuation to expect this trend in the future of members living longer. So we'll continue to monitor how long members are living compared to the revised assumption at future valuations and take into consideration any future changes in long-term trends for longevity. This is another illustration, actually, of the value of regular actuarial valuations to perform that financial check on the plan, and course correct is needed. And to allow the board to focus on long-term and to continue to pay the promised benefits for all members.
Great, thanks for that answer. So you did touch on life longevity and mortality a little bit, and we're just moving on to our last question, which is a little bit more specific. But here's the question. Is the average lifespan of retired members increasing? And if so, what is the age of females and males at end of life? Is this age higher or lower than the Canadian average?
Thanks, Glenn. So as an actuary, this is a question I frequently get asked, so I'm more than happy to provide some additional details. What I will say first up about the response to this question, though, is pension plans like the MPP, we're dealing with a very large number of members. So the law of averages means that we can truly talk in average terms. Obviously, the numbers that I'm about to give you, if you're looking at an individual member, their experiences may well differ. So life expectancy varies depending on the member's current age. So let's take an example of a 65-year-old plan member. If that plan member is male, then we can expect that member to live to close to 90. Current projections. That's an additional 25 years of the average life expectancy there. Now, females, apologies. I apologize to you every single time I answer this question for you, Glenn, but females do live slightly longer than males. Around about 2.5 years in addition. So we could expect a 65-year-old female plan member to live on average to about 92.5 these days. And another part of the question asked if pension plan members typically live longer than the general population. And that is indeed the case. There are a number of factors as to why that is the case. So I'll touch on two of the more significant factors there. Firstly is the fact that members who participate in a workforce pension plan are currently or have been actively employed in order for them to be participating in the plan. So in other words, their health status is such that they can work. And health is really a key indicator of longevity. And hence that's one reason why we tend to see that pension plan members live longer than the general population. The second main factor is that pension plan members have that additional pension income in retirement. And that may afford them a more comfortable lifestyle in their retirement. General population, they may be more reliant on government and personal savings in retirement. So that additional income for a pension plan member is also a key factor in longevity. So I think you can see why longevity is indeed an important factor in pension plans and a key consideration in the pension plan being able to continue to pay the promised benefits to all of its members.
Well, great. And thank you, Catherine. Thanks for all the information you provided, answering the questions. That does conclude our information session on the valuation. I do want to thank everyone for watching and submitting your questions beforehand, and I hope you got some value out of this session. Thank you.